I mean, these are the best market conditions that we've had for primary issuance for at least 2 years, if not longer. You've got credit spreads at all-time lows, or not all-time lows, 3-4 year lows, and obviously equity markets at all-time highs. And the good thing for us and for the market has been that investors have been very, very receptive to primary issuance.
Mm-hmm. Talk us through the risk spectrum and the sort of issuers. What are we seeing here?
So you've got the IG bond market, which is up roughly 30% year over year in volume terms, and that's a big number. That's 60 billion more than this time last year. You've got financials, which are broadly flat, but actually within financials, the subordinated issuance is up over 100%, just showing kind of a capital retirement theme from the banks. But the really exciting thing is that in the leveraged finance markets, we are basically surpassing last year's full year volumes in the next couple of weeks, and that market has just been absolutely on fire all year.
So it's been on a tear. What exactly is that down to? And is this sort of exuberance or euphoria, whatever you want to call it, is it warranted? Or do you see a lot of risk out there that isn't really appreciated by the market?
There's absolutely some risks. I think what's driving it is that we have this great combination of kind of a Goldilocks soft landing scenario where investors can see that rates are probably coming down over time. But they're not coming down because we have sort of massive economic underperformance. They're coming down because inflation is slowing. And the most important thing is company performance is actually very good. So we did a survey of all the Q1 earnings calls, Europe and US, analyzed those, and basically the theme is robust demand for absolutely most companies. And that's really what's underpinning the market.
What could derail that, if anything?
So I think many people are looking at the market as kind of a 10-month market this year. Mm-hmm. And what I mean by that is there's a lot of, especially on the debt side, issuance where people have things they want to do and they're trying to get it done before you start getting into the US election season. So what would derail the market is more if we get sudden economic downturns, mm-hmm. Europe, US, obviously big geopolitics. But I think there's also an effect that companies are trying to issue as much debt as possible before the uncertainty that might come at the end of the year.
So basically you're saying there's a lot of front loading ahead of the geopolitical risk events later on this year, the US elections, not necessarily though because they feel worried about rates volatility. Is that pretty much priced in? Is that sort of a baked into the cake?
I think so. Obviously, there's always the potential for surprise. And back in April, we saw obviously a CPI print
right.
that made people question what the glide path actually is. Yeah. I think now we're back to just a slow decline in inflation, benign rates environment, and central banks thankfully aren't as central to the capital markets as they were when rates were on their way up. Mm-hmm.